If you've been reading headlines this week, you're probably completely confused. Some economists are saying rates might go up for years. Bond yields are jumping around. Gold and metals are exploding higher, and yet the economy in Canada is clearly slowing. So the big question is, are variable rates still the smart move right now, or are we heading into a world where fixed rates just keep climbing? Today, I'm going to cut through the noise, walk through the exact signals that we watch every week, and tell you clearly what strategy makes sense right now. So let's get into it. If you're new here, my name is Greg Williamson. I'm a mortgage broker with over 30 years in the business. But more importantly, I don't believe that mortgages should be set it and forget it. Sign here, we'll talk to you in 5 years. Just like an investment portfolio gets managed as markets change, your mortgage should be actively managed too. Every week on this channel, I break it down. What's happening in the economy, what's happening in the bond markets, what that means for mortgage rates and your strategy, and what is a strategy that makes the most sense right now. Not wishy-washy, not it depends on you, you should do what you feel is right. Real calls. Like right now, markets are sending really mixed signals. On one hand, some economists are forecasting higher rates into the future. Forward curves are sloping up, no question. 4-year swaps are way up, and people are talking about inflation coming back. On the other hand, consumers are stretched. The housing market in Canada is slowing and very wobbly, and the job market is also really tepid. Canada's flirting with recession, so what's going on? The short answer is we're in a messy transition phase. The economy is slowing, but bond investors are demanding a big risk premium right now because they don't trust that inflation is gone. And that's why yields feel stubborn in Canada. This doesn't mean that rates are about to skyrocket forever. It just means markets are nervous. I want to talk about something that's flying a bit under the radar, but actually matters a lot for your mortgage rates. And it's about what's happening with Japan and the US dollar. There's growing chatter that the US and Japan may step in together to weaken the US dollar and support the Japanese yen. Now, that might sound like some obscure currency thing. Why would that matter for my Canadian mortgage? But historically, when this happens, it's a big deal for global markets. We've seen it before. In 1985 with the Plaza Accord and in 1998 during the Asian financial crisis. And every time the US intentionally weakens their dollar, what happens? Global liquidity rises, stress in the market eases, and bond yields tend to fall first. It's a form of stealth stimulus. The Fed sells dollars, buys yen, and injects liquidity into the system to calm things down. And here's why that matters for Canadian mortgage rates. Canadian fixed rates follow the bond yields, and our bond yields very closely follow US Treasuries. When global stress rises and central banks step in with liquidity like this, money usually flows into bonds, pushing yields lower. It's no longer bond investors trying to figure out what's going on. They know. And ironically, the very instability that people are worried about is often what drives fixed rates down in the short term. Yes, more stimulus, more money printing, and more currency debasement can eventually feed inflation again, and likely will. But historically, the sequence is always the same. First comes intervention and falling yields. Later comes the inflation fight and higher interest rates. Right now, we're still in that first phase. So when you hear about Japan, currency stress, potential US intervention, that's automatically not bad for fixed mortgage rates. In fact, in the near term, it's usually supportive for lower yields and lower fixed rates, which lines up with our base case that there's still room for fixed rates to ease before the longer-term inflation story really starts to assert itself. While the long-term debt and inflation risks are in fact real, and we'll keep watching them, the near-term forces in the market are still pointing towards pressure for yields to come down, not explode higher. Here's another clue worth paying attention to. Historically, when the inflation rate in Canada is at the point that it is right now, bond yields were 235 basis points on average lower than where they are right now. So said another way, 5-year fixed rates historically should be today 2.35% lower than what they actually are. So if we're at say 4.3, 4.5-ish, then call it 2.5%. would be potentially a more reasonable 5-year fix right now. And so there's a lot of risk premium being priced into bonds right now. Simply put, as I've been saying, bond yields suggest investors are concerned and fearful of future inflation. But we need to have the central bank fight on the slumping economy first before we get the resulting inflation. This is the thing we watch for, because that will create a window for fixed rates to drop. We've seen it before. Pre-COVID, stimulus came in, yields went down, economies got massive liquidity, and then the rates all fell, both short and long, but then we paid the bill on the way back up with the inflation. It's possible that we think the US money printer and liquidity globally is going to be dwarf what it does in COVID. So there's a good chance we could see a small window of shorter term fixed rates. Let me walk you through the signs we track every single week. This is our mortgage market dashboard. It's the foundation of our strategy. Economic growth in Canada is slowing. Consumers are tired. The Canadian housing market is under pressure. Central banks cannot hike aggressively into that environment. So our base case of flat to leaning low variable rate, still what we think is true. Employment trends. Job losses are creeping up. Recent strength has been seasonal and part-time. The weaker labor markets always will lead to easier federal bank policy. So, bond yields and swaps. This is important because the yields are elevated, but that's largely due to the fear and risk premium, not strong growth. When fear fades, or liquidity improves, or bond investors have clarity, then yields tend to fall fast. Inflation trend, that's number 4. Inflation is cooling overall. Even if month-to-month numbers bounce, central banks care most about the trend, not the noise. And the trend is inflation is cooling. Number 5 is global pressures. The US can't afford sustained high rates. They are desperately trying to avoid a debt spiral. This will bring on historic amounts of stimulus, aka the money printer, aka massive increased liquidity, and this will make bond yields typically fall. And Canada just can't diverge from the US for long. Historically, we always follow. Markets are pricing in hikes years from now. This is what the charts that you're seeing are. Here's the truth. These forward curves are often wrong in the turning point or the timing. Anybody could say that rates are trending up 2, 3, 4, 5 years down the road. That's probably true. But what's going to happen between now and when that turns? They almost always project higher rates just before the rates fall. Why? Because markets extrapolate the present. And when uncertainty is high, like it is right now, investors are demanding premiums. Those premiums don't last forever. Once the investors get clarity and see that there's liquidity, that see the market is, the federal banks are basically got things under control, then they flee to bonds, and that will bring yields down, which will bring down fixed rates. At least that's what we're hoping for. And we can see it. And so now here's the important evolution in our strategy. Although our base case is still variable rates make sense right now, as long as they're managed. But the environment is much more volatile. We're tightening the decision rules ever so carefully. Variable is no longer automatic. It's everybody should take it. Although right now the stats are 45% of all new Canadian mortgages are going variable, and most of them not managed. But variable is a strategy, and it needs guardrails. It needs active management. It needs people watching it. If you take variable, you must be able to ride some volatility. You must have a clear exit plan when this happens, and you must not panic lock at the worst moment. That's what many people did in 2023. They locked in at high 5% fixed rates just before variables were coming back down. So we now set those specific triggers, like when fixed drop to a certain level, we lock. When bond spreads normalize, we lock. If yields break out and stay elevated, we reassess. If the client can't tolerate more risk, then fixed or a hybrid mortgage may be better. This is active mortgage management, not guessing. On the flip side, if you take a fixed rate today at say 4.25%, and 6 months from now, that fixed rate can be had for say 3.75%, and you're watching money being left on the table, what can you do? If you're at a bank or a broker who is not set up to manage your mortgage ongoing, you probably won't even know you're losing thousands of dollars in lost opportunity. But if you did know, there's really nothing you can do because of the punitive penalty that your lender will no doubt charge. Now, this seems unfair, doesn't it? Well, drop us a line and let's have a chat. We've designed a $5,000 penalty guarantee or 50-50 split program. If we're managing your mortgage, we are so confident in our track record to get it right that we guarantee that you will never pay a penalty higher than $5,000. Or if your overall penalty is lower than $5,000 due to a relatively smaller mortgage, then we'll split that penalty with you 50-50. So you're at a bank, rates fall, your penalty is quoted at $12,000. There's no option for you. Close your eyes, go about your life, and with a big sigh. You're no doubt losing money, but there's nothing else you can do about it. But with us, let's say you pay $5,000, we pay $7,000. Now, you have headroom to negotiate. You could grab that 3.75% mortgage, and for the next 4 years, you would save several $1,000s. Imagine, go from 4.25 to 3.75, penalty's $5,000, but I save $20,000 over the next 4 years. That's a no-brainer. And that's what managing your mortgage looks like. You can schedule a call with us by clicking the link in the description or in the first comment below. So, here's my honest call for this week. Variable is still likely the smarter starting point for most borrowers. Why? Canada's economy is slowing. Global stress is rising, which will bring about easing, which will bring about Fed intervention. And that brings clarity, which brings down yields. Central banks are unlikely to hike in this environment. We already know the US Fed's going to be dropping a lot. The Bank of Canada cannot hike in the type of economy that we're looking at right now. Over the next 12 to 18 months, the pressure is way more toward easier policy. If you're buying a home or you're renewing a mortgage or you just want smarter advice than what banks typically are set up to do, subscribe to this channel and check the link in the description to book a strategy call with me or my team. Your mortgage shouldn't be guessed about. We're talking about several hundreds of thousands of dollars. Your mortgage should be managed. See you next week on the next video.